accounting in the books of lessee. So what the standard says is, if it is a short term lease, that is 12 months or less, or if it is a low value asset, then the lessee may choose to not apply lease accounting. What do I mean by that? What do I mean by that is, in such cases, do not account for such kind of transactions as lease transactions. Account for them as if you are making a normal rental payment or normal payment for use of that asset. Now, this exemption related to short-term lease has to be done by class of assets. So, whatever are the leases for a particular class of asset, you will have to apply the exemption for the entire class of asset meeting the 12 months or less criteria. Now, the standard does not define what is the meaning of low value or what are the thresholds for determining the low value. It is more left on the management judgment. Okay.
To keep yourself updated, subscribe to Indigolearn and click the bell icon, and download our app OneFin to start learning on the go.
If you see whether a contract contains a lease or not, to determine that itself is a task. Identifying an asset, whether there is an identified asset or not, that is also a task. Then you calculate the lease payments, prepare a discounting table, calculate the lease liability, interest, ROU asset, depreciation, remeasurement of lease liability. So much of complexity, so many calculations, so much of burden is what Ind AS 116 puts on the heads of the lessee. Yeah, the lessee is carrying a burden of calculating all of these things. Now, sometimes what happens is in businesses, leases may be taken for a very short period of time. Say for example, for argument's sake, we have Vijay Mallya, brother of Ajay Mallya, and he wants luxury cars. Every 3 months he wants to change cars and he wants to get a new car and use that car. So what the company does is, the Kingfisher Airlines, I'm just giving a hypothetical situation, right? The Kingfisher Airlines, what it does is, for a 3-month period, it identifies a luxury car, a particular model, a particular registration number, a particular color, and for 3 months that car is taken on lease. Okay. After 3-month period, the car is given back and another car is taken on lease. So like this, Kingfisher keeps on taking cars on lease. Now, is there an identified asset? Yes, the asset is identified. And does the contract contain a lease? Yes, because the lessee gets the right to control the use of that asset. Are there lease payments? Yes, they are also lease payments. Now, think of it from the point of view of the lessee. What is the lessee supposed to do? The lessee is supposed to compute the lease liability and right of use asset. For a 3-month period, the lessee is supposed to calculate what is the right of use asset and what is the lease liability and do the accounting accordingly, right? Based on whatever we have learned so far. Now, the accountant is tensed because every 3 months you have to do the calculation, that is one thing. The discount rate is 7.67%. So, 7.67% per annum, you have to calculate for 3 months period, do a monthly, interest calculation, do so many entries. It's become a headache for him. Like this, there may be many cases where, for genuine reasons, companies may be taking asset on leases for a very short term period. Maybe let us say today, we have hired an additional animation to animate, financial reporting course. And for a 6-month period, we need 2 additional computers, right? Non-cancelable period, there is a right of use asset, the asset is identified, everything is there. But just think of it, for 2 assets, which is for a short-term period, if I have to do all these calculations, is it not a waste of time and energy? So, Ind AS 116 realizes this fact, and what it says is, there are some exemptions which are given to lessees. I am talking only about lessees. There are some exemptions which are given to lessees as far as lease accounting is concerned. What are the exemptions? One is short-term lease. Now, what is the short-term lease? Lease for a period of 12 months or less. So, that is a short-term lease. So, one aspect for exemption is short-term lease, and another aspect of exemption is for low value assets. Let us say we take a mobile phone on lease. Is it possible? Yes, it is absolutely possible. Now, that mobile phone is of a low value. Now, for that also, if I have to do all this natak and drama for calculations, it becomes really difficult, right? So, what the standard says is, if it is a short-term lease, that is 12 months or less, or if it is a low value asset, then the lessee may choose to not apply lease accounting. What do I mean by that? What do I mean by that is, in such cases, do not account for such kind of transactions as lease transactions. Account for them as if you are making a normal rental payment or normal payment for use of that asset. Similar to the ones what you used to do if it was an operating lease as per AS 19. Okay. So, basically, you take the total lease rentals, divide it by the number of periods or number of months, on a straight line method basis, you charge it off to the P&L, right? So, this exemption is given for lessee for these 2 categories. Now, we need to understand what all falls in this short term leases. We also need to understand what all falls in these low value assets, and how do we calculate the amount to be charged or debited to P&L. A lessee may elect not to apply the requirements of lease accounting to short-term leases and leases for which the underlying asset is of low value. So, for these two categories, a lessee may choose not to apply, meaning to say if the lessee still wants, if the accountant is highly motivated, he feels that even if it is interest rate like 3.1416 and so on, I will do the accounting, perfectly fine, please go ahead and do. But if the lessee feels that it's too much of a burden, too much of a calculation involved, and see, for short-term leases, because the period itself is, let us say, 3 months or 6 months or 9 months, the time value of money will also not be material. It will impact mostly the same accounting period. In some cases, it may go to the next accounting period, but if you look at the time value of money, if you look at the materiality related aspect, it will not make much of a difference. So, in such cases, what the standard says is, Mr. Lessee, if you want, you do not account for short-term leases and leases for which the underlying asset is of low value. In these two cases, you may choose not to apply the lease accounting. You can account for it by directly charging off the payments to P&L on a straight line basis or on some other systematic basis. So, what's a short-term lease? A lease that at the commencement date has a lease term of 12 months or less, and a lease that contains a purchase option is not a short-term lease. So, there are two things what we need to understand. First, you have to check for this criteria on the commencement date and see whether the lease term is 12 months or less. If it is less than 12 months or if it is 12 months or less, then in that case you can call it to be a short-term lease. This checking has to happen at the commencement date. Say for example, at the commencement date, the lease is a 15 months lease, for example, it's a 15-month lease. After 6 months, you decide to exercise the termination option, which reduces the lease term to 9 months from the original date. Okay, so if there is some form of termination option, and because you exercise that termination option, now the lease term has come down to 9 months from the original date. Does it mean it is a short-term lease? No, it is not a short-term lease, because at the commencement date, the lease term is 15 months. So, you have to consider the commencement date and see what is the lease term, and if it is 12 months or less, then you can consider it to be a short-term lease. And the second thing what the definition says is, a lease that contains a purchase option is not a short-term lease. So, what do I mean by that? Say Kingfisher takes a car on lease for a period of 3 months with a purchase option. Now, if the contract has a purchase option, then it cannot be considered to be a short-term lease, right? So, maybe if Mr. Mala says, okay, I like this car, I will buy this car after I use it. If such kind of option is given, whether or not the lessee is reasonably certain to exercise on all of that, that is irrelevant. If it has a purchase option, it cannot be considered to be a short-term lease. Now, this exemption related to short-term lease has to be done by class of assets. So, whatever are the leases for a particular class of asset, you will have to apply the exemption for the entire class of asset, meeting the 12 months or less criteria. Now, what do I mean by that? Say for example, you are the finance manager of a car rental company. Okay. Now, the company takes car on lease for different terms. Say some cars for 3 months period, some for 6 months, some for 9 months, some for 2 years, some for 3 years period. So, like this you have different terms of lease. Okay. Now, is lease for an underlying class of asset which is car. Okay. Now, if you want to apply the exemption for short-term lease, then you have to consider all the lease of these cars up to a period of 12 months. So, wherever the lease term is up to a period of 12 months, for those leases you will have to apply the exemption. For balance, you will not apply the exemption. Now, you cannot say that this 9-month car I will account for it as a normal lease transaction, and for 3 months and 6 months I will apply the exemption. That is not allowed. Wherever there is a short-term lease which does not have a purchase option, and if you are applying it to a particular asset in a class of asset, you will have to apply it for all the leases of that particular class. See, if it is beyond 12 months, anyways you will have to do a normal lease accounting. If it has a purchase option, even in that case you will have to do the normal lease accounting. But otherwise, for a particular class of asset up to a period of 12 months, whatever are the leases, for all of those leases you have to apply this particular exemption. You cannot do it on a selective basis. Similar to the things what we have learnt in cost or revaluation model in Ind AS 16, when you apply a model to a particular item in a class of asset, you will apply it to all the items in that particular class. So, same logic applies here as well. And so, this exemption has to be taken by considering leases of a class of asset which are up to a period of 12 months and which do not have a purchase option. Let's take an example. Say there is a lease of a particular asset. Okay, it meets all the other criteria. And now looking at the term of the lease is for a 9 months period with an option to extend which the lessee is likely to exercise, and the option to extend is for a 6-month period. So the non-cancelable term is 9 months and the option to extend is for a 6-month period, and the lessee is reasonably certain that the lessee will exercise the extension option. Now here, do we classify it as a short-term lease or not a short-term lease? Now for this you have to calculate the lease term. What is the lease term? The lease term is 9 months plus the option to extend which the lessee is likely to exercise. 9 plus 6 months makes it 15 months. So at the commencement of the lease itself, the lease is for a 15-month period, then this particular lease cannot be called a short-term lease. Now what if after 3 months the lessee decides not to exercise the option to extend? Even in that case, you cannot consider it to be a short-term lease because the assessment has to be done at the commencement of the lease. The second exemption that is given to the lessee is for lease of underlying assets of low value. Now what is the meaning of this low value? Now the standard does not define what is the meaning of low value or what are the thresholds for determining the low value. It is more left on the management judgment. Okay. Now say for example, we have taken a computer on lease. Okay. Considering the size of the business, considering the materiality, we consider that the computer is of a high value for our business. Same thing, if I take the case of Reliance, and if Reliance has taken a computer on lease, do you think Reliance will consider this particular computer to be of a significant value, to be of a great value to the business? See, for a company which has lakhs of crores of revenues, for them, a small computer which is taken on lease is immaterial, right? Is immaterial. So, can we decide on the base of materiality, given the size of the company, given the size of the operation, that an asset is of low value or the asset is not of low value? The standard says you should not apply materiality. Materiality you do in audit. In audit you say this computer is not material, we'll ignore that. That is a different thing. But for Ind AS 116, don't take materiality related values, consider the absolute value. So, because for a company like Reliance, even a car may not be material. See, 2 lakh crores of revenue, a car worth 5 lakh may not be material. Okay. So there, what the standard says is, for lease purpose, don't take materiality related values, take absolute values. And these absolute values should be for a new asset. Meaning to say, if I have taken a 10-year-old car on lease, don't take the current value of the 10-year car. Take the value of a new car. So basically, whether an asset is of low value or not, it has to be decided based on value for a new asset, for similar new asset, and absolute value and not based on materiality. So maybe a computer worth 20-25,000 may be considered to be of a low value even for Indigolearn and even for Reliance. That is very much possible. Okay. But if it is a car is worth, let us say 10 lakhs, then for Reliance also it is not of low value, for Indigolearn also it is not of low value. I have taken a 10-year-old car on lease. The current value of that car is 1 lakh. Don't consider that 1 lakh, consider the original value, consider the original value or consider the value of a new asset to determine whether the underlying asset is of low value or not. So, what will we cover in these low value assets? Maybe some mobile phones, maybe some personal computers, maybe some laptops, low value equipments, maybe something like a water cooler, maybe something like a coffee vending machine, right? All of these can be considered to be of low value. Okay, but again it's an absolute term and it is to be based on the judgment of the management. Don't compute materiality in determining whether the underlying asset is of low value or not. Now, apart from the value criteria, the standard also provides 2 conditions to decide whether you can apply this low value related exemption or not. The standard says an underlying asset can be of low value only if both of the following conditions are satisfied. The first condition is the lessee can benefit from use of the underlying asset on its own or together with other resources that are readily available to the lessee. So, first thing is that asset should give me benefit either on its own or we should be using that asset with some other resources which are readily available with me. So, that is the first condition. And the second condition is the asset is not highly dependent on or highly interrelated with other assets. So, basically that asset which is of low value should be kind of an independent asset. It should work on its own or with limited interrelation with other assets. For example, if I take a computer on lease, that computer can function on its own. So, and if the value is low, I can take the exemption under the low value asset. But say for example, instead of taking the entire computer on lease, I have just taken the hard disk on lease and the hard disk is worth, let us say 15,000. Now that hard disk, can I use that hard disk independently? I cannot use it independently. The usage of hard disk is dependent on the computer. I may be having the computer, but the hard disk on its own is of no use to me. It is highly dependent on the computer that I am using. So hard disk in that case will not fall under the exemption criteria of low value assets. Sounds somehow weird, but that is how the conditions have been given in Ind AS 116. Now this is more for practical application. In examination they may directly mention that this is of a low value item, and or you may have to decide based on the value whether the exemption can be taken or not, right? So this is the aspect related to low value assets. Now the standard also mentions that if a lessee intends to sublease the asset, meaning to say there is a lessor, let us say A, there is a lessee B and there is a sublessee C. A has given the asset on lease to B, B will sublease that asset to C. So here B has taken an asset on lease and B will further be subletting that particular asset to C. So the transaction between B and C is called the sublease, transaction between A and B is called the head lease. Now what the standard says is, if the asset will be leased out, what the standard says is, if there will be a sublease of the asset, then the head lease does not qualify as a low value asset. Meaning to say, if the lessee gives off that asset on a sublease or intends to give that asset on a sublease, then the head lease, the lease between the original lessor, that is A, and the lessee B cannot be classified as a lease of low value assets. Now sometimes what happens is, the lessee may take multiple assets of low value under a single lease. Let us say a lessee enters into a contract for 100 mobile phones. Now each mobile phone is a low value asset, that is very clear, okay, because they can be used independently, the absolute value is also low. So assume that each mobile phone is of a low value. But if you look at the aggregation of all the mobiles, you may think that this is not of a low value because each mobile may be 10,000, but all the mobiles put together comes to 1 lakh. So 1 lakh may not be of a low value. Now what the standard says is, if each asset which is within the scope of the contract is a low value asset, then you can apply the. Now in such cases what you can do is, because each asset is of a low value, the combined lease may be of a higher value, but individual asset is of a low value, then in such cases you can take the exemption considering the assets to be of a low value. So basically it has to be done on a lease to lease basis, right? Each contract you have to evaluate separately and take a decision. Whereas for the term related exemption, you have to do it for an entire class of assets. Let's take a very simple example and understand the accounting for leases where the lessee has opted for this exemption. Now exemption can be because it's a short term lease, or it can be because it is a low value asset. So accounting treatment is same, but the standard says is, you expense the payments on a straight line basis or any other basis which reflects the pattern of consumption of benefits, right? So in either of these two ways you can do it. You can use a SLM basis, you can do it on the basis of number of units of production, all of those things can be done. So we'll consider SLM basis and we'll do the accounting, right? So let's say there is a low value asset for a 3-year period, commencement is year 1, lease payment each year is 2000, 2500 and 2100. So this is payment in year 2 and this is payment in year 3, okay. Now how should we account for it? So you have year 1, 2, 3, payment 2000, 2500 and 2100. So what you do is you find out the total. Total is 6600, okay. So expense per year will be how much? 6600 divided by 3, which is 2200. So every period you will have an expense of 2200 which will be charged to the P&L like you would do in the case of an operating lease. But then you see, you pay 2000 but there is an expense of 2200. So there is a difference of 200 here, difference of plus 300 here and difference of another 100 here. Now how do we do the accounting for this? Okay. So for year 1 you would say lease expenses debit how much? 2200 to bank or to payable to or to lessor. How much are we paying? We are paying 2000 only, and the balance will be kept in the lease equalization reserve, or the balance can be kept as a liability in the lessor account. Either way it is fine, but a more appropriate way is to keep it under lease equalization reserve. So to lease equalization reserve, not the reserves in surplus, okay, this is also a liability. So to lease equalization, which is 2200 minus 2200 is the credit balance. We can keep it in the lessor's account also, that's also fine. Now this is year 1. Now what happens in year 2? In year 2, Lease expense will remain 2200. To bank, if you see, is how much? To bank, if you see, is 2500. So 2500 means there is no credit to lease equalization. So this part goes off. So you will have one more item. You will debit to lease equalization. How much? Difference of 300. Okay. So first year credit of 200, second year debit of 300, which you will be using, and in the third period you have lease expenses 2200. To bank, how much is the payment? 2100. So 2100, and the balance 100 will be credited to lease equalization. So 100 of credit, 200 of credit here, 300, 300 of debit here. So this is how it will be knocked off. So this 200 credit and this 100 of credit from here. So 200 plus 100 makes it 300. The lessor gets 2000 plus 2500 plus 2100, and this is how the accounting is done. Sir, are we not ignoring the time value factor? Yes, we are ignoring, because it's an exemption given. For a small payment of 2200, you start discounting, creating a liability, the accountant will waste half a day. Okay, so the standard says, don't worry, use the exemption criteria. Let's have a look at a question to understand whether the exemption related to short-term lease is available in this case or not. Entity X Lessee manufactures phone handsets. Okay, they manufacture phone handsets, but that doesn't mean that they will lease phone handsets. X enters into a 10-year lease contract with entity Y of a non-specialized machine to be used in manufacturing parts of phone A1. Now don't think that because it's 10 year, it's not a short-term lease, because the question is a long one. So you have to read the question till the end and then decide on the case. It expects this model of phone to remain popular with customer until it completes development and testing of an upgraded model phone A2. So there is a machine will be used to manufacture parts for A1. The new model A2 will be tested and launched later in the near future within 1 year period. That is what the question says. So till such time the lessee will be using this particular machine. The current machine can be easily replaced and the cost to install it in X manufacturing facility is not significant. So though we have taken a machine on these, if you want you can easily replace. Okay, there are many suppliers available maybe, and the cost to install is also not significant. So there is not much loss to the lessee as well. X and Y have the right to terminate the lease without a penalty on each anniversary of lease commencement date. Now what does this mean? Let us say it commenced on 1st of January of year 1. First anniversary comes on 1st of January of year 2. Okay, so by 31st of December maybe either party, if they want, they can just say, okay, we want to cancel the lease, take your asset back, we don't know you, you don't know me, we can cancel the lease. Okay, that is possible, and when? Each anniversary date, which means by the end of the first year, if the lessee wants, lessee can replace the machine. There is no binding contract on the lessee to continue to use that asset beyond a period of 1 year. In other words, what is the non-cancelable period? The non-cancelable period at the commencement of the lease is only 1 year. Okay. Sir, what if the lessee renews? If it renews, then you will again evaluate it separately as a separate lease, and then you will do the accounting for it. But at the commencement of the lease, the non-cancelable period is 1 year only. Okay. The lease agreement does not provide any purchase option in respect of the leased asset to entity X. So there is no purchase option involved. Whether the recognition exemption for short-term leases as per paragraph 5 of Ind AS 116 is available to entity X. Now what you need to see here is, what is a short-term lease? A short-term lease is a lease which has a lease term of 12 months or less, and it should not have a purchase option. What is the lease term? We have just calculated. See, the contract is for a 10-year period, but the lease term, which is the non-cancelable period plus any option to extend, that put together is 1 year only, because every anniversary you have the right to terminate the lease without significant penalty, and this lease also does not have a purchase option. So very well entity X can choose to apply the exemption given by paragraph 5. The next part says, would the answer be different if the development and testing of the upgraded model is expected to be completed in 3 years rather than 1 year? Now will my answer change? So again I need to ask, what is the non-cancelable period? Non-cancelable period is still 1 year unless the question says the lessee is reasonably certain to exercise the extension option. If you look at the facts of the case, maybe the testing will take more than 1 year. I may get another machine, I may purchase another machine, I may replace this machine, right? So there is no compulsion on the lessee to extend the lease. See, if it was a case like getting a new machine is difficult, replacement of the machine will involve a significant cost, then we can say that the lessee is reasonably certain to exercise the extension option. But none of the facts suggest that the lessee is reasonably certain to exercise the extension option, and hence the lease term will be restricted to 1 year and it will be qualified to be called as a short-term lease, and the lessee can happily take the exemption. Right. Now with this, you also need to understand what happens in the general property rental market. This is an asset related question, but what happens in the property rental market? You will have a property rental agreement generally put in place for 11 months period. There are multiple reasons for this. If it is more than a year, then you will have to pay stamp duty and all of that thing. That's a different case, but generally it is restricted to 11 months period. After 11 months, it can be renewed and it can be extended for another 11 months period. So at the commencement date, such leases will also qualify as exemption under short-term lease, and then after 11 months period, if you renew, then again it will be a new short-term lease, and then you will continue to account for it in the same way further as well. Now, if the lessee has accounted for something as a short-term lease and there is a lease modification later on, then you will consider the lease modification to be a new lease altogether. Okay, so you will have to evaluate the new lease with a fresh set of eyes. That is one aspect. The second thing is, if there is a change in lease term, for example, there is an option to extend and the lessee is now reasonably certain to exercise that option to extend, even in that case, you will consider this change to be a new lease. So what the standard says is, if the lessee accounts for short-term leases, then the lessee shall consider the lease to be a new lease if there is a lease modification or there is any change in the lease term. Now, lease modification is what? Changing the terms and conditions, maybe extending the term, maybe changing the consideration for the lease, right? All of those things are what we have understood as a part of lease modification. If there is any lease modification for a short-term lease, then you consider it to be a new lease altogether. Then, if there is a change in the lease term, option to extend now becoming reasonably certain to be exercised, now in that case also you will consider it to be a new lease.